Everyone loves drama, but I don't do drama for clicks. I do analysis. If you own property in Ontario or care about where the market is headed, listen up. Over the next 10-20 minutes, I'm going to walk you through 10 Ontario markets that are at risk of getting hammered. And why? I'll show you the data, the local warning signs, and what you should do if you live in one of these places. There's facts and a plan. So why are some Ontario markets vulnerable right now? Let's frame this first. Canada's housing picture is mixed in 2025. The national market is stuck in neutral, not collapsing, but certainly not booming. Builders aren't producing enough of the right housing, and Ontario in particular has seen starts and construction slowdowns while population and demand surged. That creates mismatches that feed price volatility and distress. The Canada Mortgage and Housing Corporation recently warned that price adjustments and regional variations will continue, with Ontario among the provinces where declines could be larger. On top of that, we are seeing signs of stress. Mortgage delinquencies are rising, lender provisions are increasing, and power of sales, distressed listings are growing fast in certain pockets. In Toronto, distressed listings expanded faster than regular inventory in recent months, a red flag. So with that background, let's walk the list. I'll do this like a tour from the GTA out to smaller Ontario markets and explain why each one is at risk. Greater Toronto area is the obvious hotspot. Start with the obvious, the GTA. This market has the highest exposure to price corrections because of sheer price levels. The renewal cliff, many mortgages renewing to higher rates, and an influx of listings in 2025 tied to both new supply and distress. New home sales in the GTA have dropped to multi-decade lows. Single family and condo sales collapsed in early 2025. Meaning builders, investors, and spec buyers are recalibrating. That sets the stage for inventory to outstrip buyers in parts of the GTA, especially for higher end and investor condos. So why this matters to you? If you are an investor with leveraged condos or a homeowner renewing a mortgage soon, the GTA's mix of rising supply and weaker demand can push prices down faster than many expect. The big risk in it isn't just prices falling. How many homeowners are one renewal away from much higher payments? Durham region, Oshawa. Oshawa and the broader Durham region grew as commuters looked for affordable options outside Toronto. But affordability only lasts until rates climb or local job markets soften. Durham saw a surge in new listings and recently rising inventory. Average sale prices have softened in 2025, with many buyers stretched to afford larger mortgages in 2021 to 2024. A slower job market or a slowdown in demand from Toronto buyers can produce sharper corrections here. Local market trackers show price softening and increased days on market. When the city's pipeline of commuters, the ex-urb markets are the first to get cold. Barrie, Simcoe County. Barrie was a pandemic top performer. People traded Toronto prices for bigger homes north of the city. That move pushed quickly higher prices and speculative development. But built-for-buyer projects are now completing while buyer demand is softer, creating pockets of oversupply and price pressure. Barrie's recent data show price growth has slowed, and some segments are vulnerable to correction. This is classic overbuilt commuter town risk. When rush hour buyers disappear, suburbs with a lot of new inventory are exposed. Hamilton enjoyed spillover demand from Toronto for years. It's seen rapid condo construction and investor activity. Recently, condo prices in Hamilton have cooled and inventory ticked up. Condo prices fell year over year in some months. That means investors who bought newer condos at peak pricing and leveraged heavily may face negative equity or carry costs if renting gets harder or vacancy rises. Hamilton's industrial boom didn't protect every neighborhood. Condos built for investors can be a weak link. Kitchener, Waterloo, and Cambridge. KW saw strong tech and growth narratives, pulling buyers from Toronto and driving prices up. But like other fast-growing tech hubs, it's sensitive to both interest rates and tech hiring cycles. Reports show prices cooling in condo segments seeing bigger declines, which matters because new construction levels were high in recent years. When a local economy tied to tech and startup chills, real estate that depends on high incomes and investor buyers is vulnerable. High expectations for tech wages are baked into some local prices. Cut those expectations and prices can fall quickly. Niagara region, St. Catherine, Niagara Falls. Niagara became a hotspot for buyers priced out of the GTA. But the region's economy is more tourism and service oriented, more exposed to economic cycles. Some local reports show stabilized or rising listings in 2025, and prices gains have moderated. If external demand from Toronto soften, Niagara's lower income rental and ownership segments could be hit hard. A tourist town's housing market is fragile when broader buyer demand falls. If this is useful, do me one favor, hit subscribe and smash the like button so more Canadians can see this analysis. Drop a comment with which city you live in, follow-up videos to the most requested regions. London, Ontario. London has grown fast, attractive for young families and students, and it saw a big run in prices. But inventory increases and slower sales are now showing up. Regions with significant student and rental markets can be hit by weaker student spending, rental oversupply, and local affordability limits. Several regional trackers show cooling in London's market in 2025. That creates downside risk if the local economy slows. Smaller cities look stable until rental demand weakens or renters can't afford rising costs. Kingston. Kingston has a strong student population and government sector's exposure, but listings have increased and price growth has flattened. With more new units coming, affordability constraints might push prices lower in the short run. Local reports show increased listings and small price declines in 2025. When supply and student demand fall of sync, smaller markets can surprise on the downside. Windsor's market enjoyed investors' interest and lower entry prices, but is anchored to auto, manufacturing, and cross-border demand. Any local jobs or drop in investor appetite can create fast shifts. Some indicators show elevated inventory and slowing price gains. Windsor is particularly exposed if auto sector weaknesses, renewed rate pressures, or cross-border changes reduce buyer demand. Local reporting and market trackers. Blue-collar towns feel volatility when both jobs and investor demand wobble. Northern, smaller Ontario centers, Sudbury, Thunder Bay, Peterborough. These smaller markets can look safe, lower prices, slower turnover until a local employer closes or a wave of renewals and higher rates hit. They are also thin markets. Modest shifts in listing or buyers translate into big percentage moves in price. Several small Ontario centers show early warning signs: rising listings, slower sales, and thin demand. These are stealth risk markets that can drop quickly when sentiment turns. Thin markets are like small boats in a storm. A few waves and they capsize. Alright, so let's do a quick recap. We walked through 10 Ontario markets that are vulnerable for a mix of reasons: oversupply of condos, commuter town overbuilding, reliance on investor demand, tech or manufacturing exposure, and rising delinquency or power of sales signals. So let me strip this down to the common themes you should watch in any market. High leverage plus renewal cliff. Millions of mortgages are up for renewal through 2026 and 2027. Many households will face higher payments. If incomes don't rise, that's stress. Bank of Canada and industry reports warning of this. Inventory spikes in specific segments. New condo towers finishing up with weaker demand. That's where distress surfaces first. Better dwelling and local MLS trackers show rising power of sale and investor pressure listings in parts of GTA. Local economy sensitivity. Cities tied to one industry, tourism, manufacturing, students, can see sharp swings. That's why Niagara, Windsor, Kingston, and some smaller centers are riskier. Construction slowdown and mismatch. Paradoxically, Ontario starts have been volatile. Some sources show sharp declines in starts in early 2025 versus prior years, which can lead to uneven supply and price instability when demand shifts. Rising delinquencies and lender caution. Credit reports show mortgage arrears increasing. That financial stress can translate into more forced listings if job losses or rate shocks grow. What homeowners, buyers, and investors should do next. If you own property in one of these markets, here are practical steps. Check your renewal date and stress test your budget. Know what your payment will look like at higher rates and have a plan. Don't assume you'll be able to sell quickly. Thin markets and condo pockets can take months to clear. Price for that reality. If you are leveraged on rental units, assume tougher rent and vacancy risk. Have cash buffers to cover several months. Avoid panic selling, but avoid burying your head. If you must sell, price to the market and work with a local agent who understands distressed inventory. Diversify. Don't hold all your net worth in local real estate. Consider TFSA RRSP allocations, dividend ETFs, or cash reserves to cushion shock. So here is my final thoughts and the big picture. Ontario is not a single market, it's many micro markets. Some will be fine, others will correct sharply. The difference between a correction and a crisis is often policy reaction, lender forbearance, and local employment resilience. Watch mortgage renewals, delinquency trends, and power of sale listings closely. CMHC and credit agencies will keep updating these signals. They matter. If you own in Ontario, don't guess. Know your exposure, know the timeline, and have a plan. If you want region by region deep dives, Toronto neighborhoods, Hamilton condos, or Barrie's suburban risk, tell me which city in the comments and I'll make a follow-up with neighborhood maps and local data. Don't forget to subscribe and share this with people who own property in Ontario. They need to hear this. I'm Thuc, your money guy, making money simple, smart, and stress-free. See you in the next one.